Welcome, welcome, welcome. Merrill Chandler here with the Fundability Report. Okay, we've got actually some pretty exciting things to discuss today. First of all, the first thing we want to review is that consumer loan trends for 2023. Now, remember, all loans coming from this report that I'm going to share with you is the 2022 loans, right? Post-COVID loans coming in, but there's high demand for consumer loans, but rising delinquencies. So remember that in fundability, one of the key things we help our tribe, our students, our clients realize is that when you chase money, those measurements, those activities are captured by lender software, right? FICO's 40 borrower behaviors, lender underwriting software. Look at the key indicators and literally can measure if we are chasing money, right? Well, rising demand means that there's a reason people are going for more loans. That reason may mean that they're in trouble. Consumers are in trouble, borrowers are in trouble. And as a result, it's correspondingly then the number of delinquencies may rise or are likely to rise in exact proportional relationship to the amount of demand, because demand, increased demand overall in a national or global way, that increase in demand creates creates the perfect storm for, yeah, the money didn't help, and so I'm going delinquent, or I was not approved for a particular loan, and so other loans I might be in go delinquent, right? And so I'll just run I'll run a few numbers here. Unsecured personal loans, the rate of delinquency is up from just barely over 2% to almost 4%. Bank cards are up from 1.25% to almost 2%, and mortgages have actually gone down. So the secured HELOCs, mortgages, and what they call HE loans here, which are technically seconds on a second mortgage in the form of a loan instead of a line of credit. All of those have gone down, whereas others are going up. So the whole point is that the recession is that rising tsunami tide, that wave that keeps cresting and growing, and its consumer lending landscape is getting tougher. So be careful when it comes in the sense of fundability. Remember, lenders make the most money when they lend, and so they're still in the market to find capable and competent borrowers. I affectionately call them bullseye borrowers, people who know how to hit the funding bullseye, the lender's bullseye when it comes to getting approvals. That's the value, that's the importance, that's what's powerful about being fundable. And so let's take a look at our next. The next one is why banks must change their approach to financial wellness. Now, this is the president of digital banking at NCR. NCR, many of you may know NCR as they're an automator, a banking service automator, and there's money-related stress rising from 18 to 43-year-olds. It's up at 82%. 18-year-olds to 43-year-olds are registering at 82% when it comes to additional stress that they're feeling as a result of money, lack of money, inflationary pressures, etc. So this article says, and what we need to be aware of is data, and several of things we've been talking about for months now. Data-driven products, data-driven access to accounts is vital and important to borrowers. I attended last week. I attended a seminar where the lenders were saying that because of this pressure, because of financial stress, the vast majority, in this case, 82%, that one said 76%. So we're still 3/4 of the people surveyed are looking for predictive information, meaning if I keep spending the way I'm spending, when do I run out of money? And tell me that I'm going to run out of money because my habits, because third-party software is measuring and monitoring my borrower behaviors, right? They want to know predictively when they're in a green zone, yellow zone, a red zone, right? They want to know so that, because right now we spend without having cash in our wallets anymore. Those days are long gone. Without cash in our wallets, we don't have, everything is just numbers. And so some personality types are very fastidious about keeping like their checking account balances. And some would even say people are irresponsible if they don't have checking account balances, don't know what's already been spent, don't know what their auto pays are. But what people have been slow on the uptake, the fintechs and developers have been slow in creating the solutions so that there's a pace of spending. Are you following me? I would even love to know what is, there's a saying, is my month running out before my money does? Or is my money running out before my month does? And so we want to know what the pace is from, especially those who are living paycheck to paycheck. So these are all, it's crazy important things that we need to understand, that fundability is the management of our borrower behaviors. And we're even working on, due before the end of the year, we're even working on our own predictive borrower behavior software, because we have that unique insight into creating awareness and modification of borrower behaviors by letting our tribe, our clients, our students know how they're behaving and how to materially affect that in a positive way. So another thing, make it personal and human was another thing in this report of how do we change financial wellness? And financial wellness is hot. And that's why, and everybody seems to be coming home to Papa when it comes to borrower data and being able to modify borrower behaviors. So we're making it, they want it to be made personal and make it human, not a bunch of digits, but make the financial journey month to month for borrowers and depositors, other consumers. How do we create an awareness so that they know where they are every moment, where their checking account is every moment, where when their direct deposits, where their savings accounts are, far more than what Mint has been doing, or some of these other software companies have been doing. Very simple and facile, not very, well, they're certainly not predictive. All right. So, and then offer tools that encourage financial proficiency. Again, it looks like they're literally asking Get Fundable, me and my team, to finish our software faster, because everything they're asking for. So offer tools that encourage financial proficiency. How do you optimize? That's weird. Those of you who've been listening to the Fundability Report, we use the term optimize for your borrower behaviors for decades now. So what are we doing? We need to make sure that people learn the process. That's what we do in our funding master course. That's what we do with our business funding master course, is learn the technology, learn what it means to create to balance your borrower behaviors with what lenders are looking for. So those amazing article. I just loved what we're reading here, because it's literally, they're asking for what we are developing, and I can't get it done fast enough. So we'll keep you posted further that. Now, here's an interesting development that's been coming up over the last quarter of 2022. Banks, there have been some banks have been losing ground, and we even got this. We talked about in our post FICO breakdown from last FICO last May. In our interview with David Smith and the originations team over at FICO, lenders are losing ground to fintechs, and small business loans are moving over to fintechs. And here's David Smith's rationale. He said they will pay a higher interest rate if the application process is simple and approved or denied is immediate, especially if they're denied that no inquiry was used to discover that they were denied, which is what fintechs are specializing in. You guys, you may even heard it yourself, where you go in, no inquiry, it's a soft pull, no inquiry, you fill out your things, and then they say, you've been approved, and then they'll do an inquiry after the approval to make sure all the numbers fit. But banks have been slow to move through this project. And so what they've been doing is they've been working on partnerships between fintechs and some of the banks. Now, the interesting thing is the banks are, it's not Wells Fargo and Chase, it's not the tier ones that are doing this, but some of the tier twos. And here are some of the fundamentals that they're working on. Number one, automatic loan underwriting is becoming essential. Now, what have we been talking about for literally years? Automatic underwriting. So they're saying that the number one in the surveys of banks of what they need to improve on in their banks, and what lenders or borrowers are looking for, automated loan underwriting is mandatory. Alternative credit data and new scoring methods. So we've got FICO. It came out with FICO XD, which is Dave Smith said it stood for extra data, meaning like alternative data. But other sources of data are coming up in the market and selling this data to the big scorers. I know that FICO uses some of this data from the banks and bank underwriting processes. So alternative data gives a broader look to unbanked persons. Are you paying their utility bills faithfully? Are you paying your rent faithfully? Are you paying your cell phone bill faithfully? Because borrower behaviors, it doesn't have to be a borrower behavior. If you're a fastidious borrower, it could be that you're paying these other alternative financial agreements perfectly. That's a borrower behavior. It doesn't have to be an auto loan or a credit card to prove that you keep your commitments, especially your financial commitments, right? And so the last thing is that insights is huge. FICO lives off the word insights and optimization. But what they want are insights. When you look at the math, we're not just looking at what the borrower behaviors, but what are the trends of borrowers, and how to meet those needs. In the last article we reviewed just a moment ago, we're literally talking about the borrowers wanting predictive insights to their own behaviors, because it's a meta concept, right? It's here we have the data, and then what does the data mean? Well, most borrowers want third-party software solutions to tell them what their borrower behaviors mean, and that's coming soon to a Get Fundable event near you, right? So that takes us to the end of our Fundability Report today. You guys, my name is Merrill Chandler. Every Tuesday, 3:45 Mountain Time, we're going to hit this hard and square in the between the eyes about What does it take for us to become fundable, and what is happening in the lending universe, in the lending matrix? What do we need to be aware of, and how do we navigate that and become most fundable in the process? This is Merrill Chandler saying thank you for joining me.